Welcome to Investors Insights, where today's topic is taking the good with the bad. A lot to talk about today. Before Ty talks about drawdowns and concentration risk, I want to first talk about some concerns we have. And so first, there is a reason we named the title of this vlog, Taking the Good with the Bad. And that is because we're always analyzing positives and negative themes in the markets. But first, I want to start with the positive. And that is, as you can see in this first chart, ISM Manufacturing Sentiment Indicator rose above 50 for the first time since October 2022. Any reading above 50 is positive, and it shows that manufacturing is now in expansion territory and has been one of the few remaining indicators that we've been looking at to show the economy is likely to avoid a recession in the near term. So that's a positive. But with the positive comes a few concerns that we are closely analyzing this week. And those are, the concerns are higher consumer delinquencies, higher energy prices, and continued uncertainty with the U.S. banking sector. So first, as you can see in this first chart here, household delinquencies have risen to troubling levels. We're seeing the highest level of auto and credit card delinquencies since 2011. The second concern is that higher energy prices have spiked in the past few months to a level that will cause multiple problems for the economy. Higher energy prices acts as a tax on families and diverts spending away from other important areas of the economy. This will no doubt have a negative impact on inflation and the Fed's goals of potentially cutting rates and fighting to bring inflation down. And final, the third concern we have right now this week is our national banking system, and more specifically, regional banks. As you can see in this chart, interest rates have spiked higher in recent weeks, causing further losses on the bonds which banks carry on their balance sheet as unrealized losses. This is an important stat here. There remains a sizable burden of $500 billion of bond losses currently on bank balance sheets. That is a concern. So as always, we are analyzing the good and the bad, and we'll be watching closely if the three concerns that I just laid out actually start to cause substantial market weakness. So Ty, talk about drawdowns and really talk about concentration risk, which has been a hot topic in recent months.
Yeah, thanks. I think I'll start with concentration. A lot has been made over the last, couple of years of the Magnificent Seven, how concentrated the S&P is, and that's all true. It's more concentrated than it has ever been. But if you look at this chart, the S&P is actually not as concentrated as a lot of the other bigger stock exchanges around the world. The top 10 holdings of the S&P make up about 33.5% of the total S&P, which again is concentrated. But when you're comparing this to some of the other ones, I mean, you're seeing 60%, 72%. I think a lot of people think the S&P has been so weighted toward the Magnificent Seven, one of which Tesla has fallen out of the top 10. But you still have those big six stocks. And I think, just kind of a misconception and, a sign of where we currently at compared to others. We've seen a drawdown in the S&P down about 4.5% or so. Since its peak. This is normal. Drawdowns, the average annual drawdown in a year is about 14%. We get a lot of news right now about the Middle East. We're getting a lot of, high energy prices, a lot of stuff going on election year. Just keep in mind that this volatility is normal, and we could see some more of it. And then kind of, on a positive side, even though the market was down on Friday, we actually saw 70% of the New York Stock Exchange issues were actually up. And so I think, that could be kind of a changing tide there. Usually you don't get a down day when 70% of the issues are up. So something to keep an eye on.
Yeah. So again, we're taking the good with the bad. So if you have any questions on anything that Ty and I discussed today, please reach out to us, call us, email us, and we'll see you next week. Thanks for watching.